we're going to be talking about the Enterprise Management Incentive Scheme, which is also referred to as the EMI Scheme. An Enterprise Management Incentive, or EMI Scheme, is a HMRC approved employee share scheme that is available to most trading companies. This scheme allows employers to grant share options to key employees tax efficiently, as either a reward for their efforts within the business or to retain and incentivise key staff. Effectively, it offers a stake in the business to employees as part of their remuneration package. So how do share options work? As a brief overview, the company would grant options to selected employees, giving them the right to buy shares in the company at a fixed price if certain conditions are met. The employee would then exercise their option to buy the shares in the company, and they would own the shares until they were eventually sold. I mentioned that there were certain conditions that must be met, and for the company, the main conditions are: it must be a trading company carrying on a qualifying trade on a commercial basis. Some trades aren't considered qualifying. There is an extensive list of excluded trades, but these include banking, farming, property development, and legal services. The total gross assets of the company must not exceed £30 million. There must be fewer than 250 full-time equivalent employees. Maximum EMI options should not be more than £3 million. And the company must be independent, meaning that it is not a 51% subsidiary of another company. For employees, the conditions are: they must be either a director or an employee. They can't have a material interest in the company, which is more than 30% of the share capital. The maximum options they can hold is £250,000. However, this includes other HMRC approved share options. And they must work for the company for at least 25 hours each week, or 75% of their total working time. There are many tax advantages that come with an EMI scheme, providing the options are granted for genuine commercial reasons. If options are granted with an exercise price, which is the amount the employee will pay when they purchase the shares, which is equal to the market value at the time of the grant, the employee will not have to pay income tax when the options are exercised. However, if the options are granted with an exercise price below the market value at the time of the grant, an income tax charge will apply when the employee exercises their options. This charge is the difference between the market value at the date of the grant and the exercise price. National insurance will also be due if the shares are classed as readily convertible assets. There is the possibility that capital gains tax may be due when the shares are sold. However, the sale may qualify for business asset disposal relief. So when would capital gains tax apply on shares acquired under the EMI scheme? If the shares are sold and a profit is made in excess of the capital gains tax annual exemption, capital gains tax will be due. Business asset disposal relief, which was formerly known as entrepreneurs relief, may apply on up to £1 million of capital gains if the following conditions are met. And this would mean that a fixed capital gains tax rate of 10% would apply, rather than the normal 10% rate within the basic rate tax band and 20% within the higher rate tax band. The conditions are: the option was granted at least 2 years prior to the disposal of the shares. The company was a trading company or a holding company of a trading group for the 2-year period immediately before disposal, and the employee was still working for the company when the shares were sold. It's worth noting that in this instance, there is no requirement for the employee to hold at least 5% of the share capital, as long as the option is exercised within 10 days of the employee leaving the company. So let's look at an example. Newco Limited grants an option to Mr. Smith on the 18th of August 2020. The option gives Mr. Smith a right to buy 12,000 shares in the company. Mr. Smith can buy the shares for £10 each at any time in the next 10 years, and the market value of the shares at the date of the grant was also £10. Mr. Smith exercised his option on the 18th of August 2023 when the market value of the shares was £13 per share. What are the tax implications? At the grant of the shares, there is no income tax charge as this is a tax advantage scheme. At the exercise of the options, again, there is no income tax charge as the option was exercised within 10 years and the option price of £10 was equal to the market value of the shares at the time of the grant, as it was also £10. On the sale of the shares, Mr. Smith may be subject to capital gains tax. His cost of the shares is £10 per share when considering the profit that he has made. Mrs. Smith is also an employee of Newco Limited, and the company grants her an option on the 25th of August 2020 to purchase 5,000 shares at £10 each. And on that date, the market value of the shares was £12. Mrs. Smith exercised her option on the 18th of August 2023 when the market value of the shares was £15. Mrs. Smith's tax implications will be slightly different, as although there is still no income tax charge at the grant of the option because it is a tax advantage scheme, there will be a tax charge when she exercises her options, as the option price was £2 lower than the market value at the date the option was granted. If the shares are readily convertible assets, that means they are quoted shares or there is an arrangement to list or sell the shares, Mrs. Smith will also need to pay national insurance. When calculating the tax due on the sale of the shares, her base cost will be £12. Mrs. Smith will need to pay income tax on the exercise of her option. The amount that she will need to pay income tax on is calculated as the difference between the market value of the shares at the grant and the option price, leading to a taxable income figure of £10,000. Now let's consider Mrs. Smith's capital gains tax position. We already know that she sold the shares on the 18th of August 2025 for £17 per share. So we know that she meets the condition that she sold the shares more than 2 years after the options were granted. In this example, we'll assume that she meets all of the other qualifying conditions and is able to claim business asset disposal relief. As with any capital gains tax calculation, you would first start by calculating the sales proceeds. In this case, she sold 5,000 shares at £17, so her proceeds were £85,000. We will then deduct the amount she paid when she exercised her option, which was £10 for 5,000 shares each, so her option price was £50,000. We would then also deduct the amount that's been charged to income tax, which was £10,000, leaving a gain of £25,000. You would then deduct the capital gains tax annual exemption, which in this example is £12,300, leaving the chargeable gain, which is the amount on which tax is to be charged on. In this instance, £12,700. As we mentioned before, being able to claim business asset disposal relief results in a flat rate tax charge at 10%. So the amount of capital gains tax that Mrs. Smith would have to pay would be £1,270. To give you an overview of how the process of setting up and running an EMI scheme works, we'll touch on a few of the key areas. In the first instance, you would identify key employees who you want to incentivise and retain and draw up a proposed capital table. You would prepare a company valuation report to the HMRC to agree the value of the shares at the date of the grant. This normally takes up to 90 days to be agreed with HMRC, but recently this time frame has been extended to 120 days due to COVID-19. Therefore, it's important to begin the process well before you intend to grant options. You would also prepare share option agreements and a working time declaration for each option holder, and these documents would be signed by both the company and the employee. Following the setup of the scheme, within 92 days of the date of the options being granted, you would need to prepare and submit an EMI notification. Then, each year, you would need to submit an Employment-Related Securities, or ERS, annual return by the 6th of July following the end of each tax year. This return would need to be filed even if there had been no reportable events. Thank you for listening to our presentation on the Enterprise Management Incentive Scheme. This has only been a brief overview, so if you want to know more about either the scheme or how Rotherham Taylor can help you, please contact us either by calling 01772 735 865 or by email at info@rtaccountants.co.uk. Thank you.